we see things as the 10-year US Treasury yield, the 10-year GGB yield, the FX, and whatever. Okay. That is the tiny tip of the iceberg. The whole structure of derivatives, cross-currency swaps, hedging, cross-border agreements like market agreement, OTC agreement, and whatnot, okay, effectively creates a system that it's function very well till there is trust. Okay, so if you want me to say what is gonna pop this bubble, I would say is perhaps like an implosion of trust that things can be bailed out by central banks.
Tuesday, July 29th, 2025, Maneco 64, home of alternative economics and contrarian views. Today I have a new guest, just Dario or Dario. Dario, welcome to the channel.
Thanks a lot.
Yeah, you're welcome. And I met Dario through X. He's got just under, I think, 65 followers, 65,000 followers, excuse me. You can follow him, just Dario. He's a co-founder of Synax. Maybe we can talk a little bit about that. He's an objective analyst, according to him, macro and facts, and that's why I like to follow him. I recommend you follow him if you're on X. And he's also got a website, just dario.com. So, Dario, before we delve into some topics, just a little bit on your background.
Yes. So for me, I spent quite a lot of time as fixed income trader in investment banking. Actually, my job was a very particular one. I was structuring private bonds. Okay, so private placement bonds, cross-border bonds, first started as a junior in London and then went through the ranks and spent a lot of time in Asia, in particular in Hong Kong, where I've been for the last 12 years. Then, of course, after many people got fed up with investment banking and looked for something more interesting, and I had almost like a couple of year experience as head of financing, head of markets in Hextrust as a crypto custodian, where effectively like I leveraged all my micro fixed income knowledge into the space. So I was actually a bit of a black sheep in that space. And then like 2 years ago, with the other two partners, we started Synex, that basically is to leverage real AI and machine learning, in particular, to provide stock intelligence and also risk intelligence broadly, both in the traditional credit market and on the blockchain. And we already have a live platform. Everyone is curious, to watch. I usually like post about that. It's pretty incredible what the models can really deliver.
Is this the company here, Synax? Is that how you?
Yeah, that's correct.
So
Yeah,
predictive credit intelligence, is that to help investors determine how
yeah.
credit markets are doing? Yeah.
Yeah, it's we focused on the credit strength on companies. So basically, all the models are geared to predict forward-looking metrics and all sort of like predictive ratios that then translate in a credit signal and probability of default within a certain period, like projected into the future. So we not like one of those firms that predicting like focus on technical analysis, like trading and whatever. We really focused on credit and on all those kind of investors that really look for long term. And also, of course, we're developing also a suite of risk metrics analytics for blockchain products that are going to go live soon.
Yeah. So, with that, could we touch upon the recent supposed win for President Trump and in terms of the EU-US trade deal? I saw you post a few comments about that. So, Could you tell us the way you see it? And as I said before, Dario is very objective. He looks at the macro. He doesn't take sides, and that's why I like to follow him. So, yeah, let's get on to this trade deal that supposedly is a great win.
Yes. So this is quite funny. Like actually on Sunday morning Hong Kong time, so I think it was Saturday evening. I posted that I expected a trade deal between the EU and the US to be announced before stock futures open. And in the meantime, like all the European mainstream media were like so talking about how far the two parties were, how Europe was threatening like to tax US internet companies on their service revenues and whatnot. And then here you go, like clockwork, the announcement arrived. And I would like to make 2 points here. There is one point that it's clearly targeted at feeding trade algorithms. Okay, all these high frequency trading algorithms are basically wired to grasp the headlines as fast as possible and trade accordingly. However, differently from the past, they don't just trade on the headline. Okay, they also trade on the momentum. Okay, that the headline can generate afterwards. Okay, and this becomes pretty much like a game of cat and mouse. But as soon as you know how to play the game, okay, then you can start feeding the algorithms and give them what they want to hear and move them in a specific direction. And in the years, we saw many examples of that. It actually, the very first one to do this was President Trump during his first term, when he figured out that his tweets can move the markets in a direction or another. Okay. Then we had, the Biden administration that had a more subtle approach that effectively was targeting specific timely announcement or, specific statistical announcement, like putting them like right just above or just below expectations, okay, lead sometimes just a pinch, okay, just a rounding error, but then you have massive reaction in the market, one side or the other that is completely disconnected, okay? So clearly here they're playing this game. I mean, it happened last week with Japan. And when the details of the deal came out, I mean, just what I tell people, just read at them, okay? Who which person that is right in his mind would ever agree on something like that? Okay. In particular, I mean, with all due respect to a prime minister that doesn't really have any much political support left. Okay. But the number per se, like, were completely bad for Japan. And, it took a couple of days to surface. In the meantime, everything went gangbusters, right? And then till the point to say, oh, well, actually, we agreed on something. We didn't write anything down and we didn't sign anything legally binding. And at some point, it came out that they pretty much disagreed on everything. So, but the announcement is there. So that's a key. So here is one side of what the markets want to hear, and they're becoming incredibly good at delivering what the markets want to hear. And then on the other side, you have effectively these trade deals. So these trade deals, in the grand scheme of things, I started to cover them quite a while ago. Okay, and in reality, okay, the goal that Donald Trump is trying to achieve, you know, um, generally speaking, is pretty understandable, right? The U.S. cannot be like 100% service economy, hyper financialized with little to no production left, like all a consumer economy that basically like is printing itself like you know through all its like reserves, okay, because that's what the fiat monetary system is, okay. The fiat money value as value when you can back it up by the wealth of the country, but if you keep inflating your monetary value without having like a strong structure of the country, in particular a productive structure, because you need to make goods, you need to make widgets, you need to export commodity, you need to transform, you need to innovate, and so on. If you are losing more and more of that because the American companies went to Mexico, Canada, China, Vietnam, whatever, at the end, you become effectively like an empty box, a pretty empty box, but sooner or later someone is going to open it. So, in principle, what it's trying to do is correct. I mean, he actually said it. The only small problem there is that the execution has been incredibly bad. Okay. And the worst part is that effectively, the United States don't put against them all their allies altogether. They're the biggest economy in the world. They are arguably the most powerful country in the world. But if you put everyone else against you, including your allies, suddenly your bargaining power drops significantly. And this is very basic. I know there are a lot of people writing complex concepts, mathematical formula, and whatever. But at the end, is like things are incredibly simple down to the core. So if you lose all your bargaining power, how are you gonna bargain? Like paradoxically, they put people they were pretty much against each other on some items and whatever. China didn't like much all this transshipping and what was going on in Asia. Europe didn't like sort of thing and whatnot. Then you had Mexico and Canada that were closer to us that went pushed far away. Paradoxically, put everyone like against themselves. Okay. Furthermore, the they missed one small but very critical element in their own calculation is that US companies, it's true that they don't export much goods anymore. They don't produce them much anymore. Okay, so they tend to import from abroad. But US companies, they export a lot of services. So in reality, when you add services into the equation, the various imbalances become incredibly smaller. Like, for example, the European Union doesn't have any hyperscaler, doesn't have any big internet company, doesn't have any big social media or whatever. They purchase everything from the United States, for example. Okay. And there are many other examples. So ultimately, like there is a structural problem here, okay, that they see all this outflow of dollar, an outflow of dollar that is accelerating. They need to increase the deficit even more. US companies are making a lot of profits. Markets are required, they make a lot of profits, but this money doesn't come back. Because one thing that they don't dare to say is that all these companies they minimize their tax bills. That's it. So Apple, 100 billion plus of liquidity. Why they keep issuing bonds in the United States? Because they keep all the liquidity abroad. Microsoft and the other and whatever. So there are all these like loopholes and arbitrage that have been left wide open during the years and then been exploited greatly. So to conclude, yeah, they should have taken a more pragmatic approach. They should have like having a more constructive approach, not just with countries, but with corporates, because you can do something with a country, but when you have corporates dealing with 100 countries, yeah, you can close a loophole here. I just start, move somewhere else and whatever. So all in all, I think this is not really gonna go much anywhere because it's a complete mess. Like they did one trade deal with UK that was UK was back in the US to do it 4 years. They took ages, okay, to start having this in principle agreement, and then when people look into details, they're like, "What did you agree on?" Like nothing. Everyone disagree on that. So, yeah, the US can impose like flat tariffs to everyone, but we know how it's going to end if you impose flat tariffs. That is going to be effectively an indirect taxation on your consumer because companies can absorb them up to a certain point. You can't threaten them politically, you can threaten to go after them, but at the end of the day, like all these people, they are bound to keep growing their revenues, to keep growing their earnings in order to see the stocks growing because all this management doesn't get paid. if their stock option don't go into the money. So in a one way or another, that these are going to be passed to the consumer. And paradoxically, if the US puts tariffs against another country, they're going to end up paying that.
Yeah, and you said you mentioned bargaining power that the U.S. is like being so adversarial, and the language as well about winning. It's like because if you win, someone loses, and I think that's the wrong way to go about it. And people might argue, well, the U.S. is being ripped off by foreigners for decades. But you just mentioned there that one of the biggest ripping off mechanisms is the U.S. corporations, and I agree with you. I mean, I have a lot of stuff that I wear or my golf clubs. They're all U.S. companies, but you look at the label, they're all made outside the U.S. So, like you said, they need to do something about that too. But in terms of the EU US deal and the algorithms, I noticed yesterday that the market I expected the stock market to go be up at least 1%, but it wasn't up that even 1%. I expected the euro to be trounced. It was pretty much unchanged early on Monday, but and then it dropped a bit. So do you think maybe all this manipulation through of the algos is that wearing off? That's the first question. And the second question, because the EU is made up of what, 27 or 28 countries? I don't know exactly, but uh, are they all going to accept this deal, or is there going to have to be some kind of like unanimous vote on it?
So that's a great question. Okay. So first of all, there is something that I always believe is fundamental in financial market, whatever. That is the law of diminishing returns. Okay. The more you keep doing something, the lower the effect that you have. Effectively, traders got played last week. And something that nobody talked about today is that, well, all the futures were bright green, effectively, not massively green, but bright green. The Nikkei closed down 1%, okay, in red. Why? No particular news hit Japan or anything whatsoever. Okay. So did Japan get played? Did people realize that there is, this kind of like announcement, shake hands, and then we figured it out later type of deal? Potentially, yes. Okay. We also need to take into account one thing. To be honest with you, this comes from my experience in banks. Like it's the 29th of July, a lot of people are on holiday. And usually when a lot of people are on holiday, they tend to put their books on a neutral risk. Okay. Because in order to take aggressive position, in order to push on certain type of direction on your book, even if you trade with algorithms, you want to be there. Okay. So I know it sounds like, you know, a little bit of a simple explanation, but this is effectively the truth. And as a matter of fact, the volumes in the market, even if stocks keeps going higher and higher, the volumes are incredibly low right now. And also, there is a you know general thing that it's important to bear in mind is that we're getting to a level of general markets stretch and over valuations, okay? It cannot be really ignored much anymore, okay? So the higher things go, the more they tend to flatten out, okay? Because everyone know how things are stretched, but everyone is trading by the day. It should not be a surprise that zero DT option volumes are now overwhelmingly higher compared to the rest of the market. So everyone, paradoxically, the more things go higher in the market, the more they tend to be um, more and more careful. This is why you lately you didn't see any massive jumps in the S&P 500 and so on, despite this all this announcement and whatever. So it's all a combination of this effort because no one wants to be the last big holders in the market.
Yeah, and in terms of the overvaluation, there's been a lot of talk that the market is going to correct, there will be a crash. But at the same time, one could argue, and I've been talking about this, that it's possible that we could see a melt up or a crack up boom. That being a fiat currency system, we are at a juncture where if you don't keep the debt going, everything implodes. So I wanted your view on that and what you think about that.
Yeah, my view on that is, you know, a very objective view. To be fair, like everything is incredibly overvalued at this point, like across the board, with one exception. And this exception I highlighted like many times. And the exception is China. So you have the first and second largest economies in the world, and the second largest economy in the world, supposedly growing at a faster pace than the first one. People might not want to believe the data that comes directly from China, but the data that comes from the Western world in terms of like trade balances, in terms of like currency movements, in terms of like shipping and so on, they pretty much align. So despite you have like this dynamic in the real world, then you have the S&P 500 that is almost outperforming the CSI 300, the main index of the large cap into China, that is outperforming them almost 100% in the past 3 to 4 years. How is that possible? That's possible because the the Chinese government voluntarily blocked any attempt from the stock market, from brokers, from lenders, whatever, to channel any liquidity that would have been made available by the central system to support of the real economy into financial assets. Okay, so you have this huge cap. The Chinese government like doesn't really care much about the stock market. I mean, they care to a certain extent, but in reality, Chinese people like they have a tiny portion of their wealth into the stock market. They have quite a bit on real estate, and that is going through quite a bit of a recovery. But they have a lot of cash savings and rather like short-dated type of debenture. And that's the very big difference is because the Chinese government doesn't measure their success with the performance of stocks effectively, but they care about all sort of other measures. All right. And also the composition of the wealth in the country is massively different. Okay. The ownership of stocks is almost negligible across the overall population compared to other country. Most of the people they have their wealth in real estates, in cash and cash deposits, and gold and silvers more and more lately. While in the United States and in other countries, less so in Europe, but still more and more lately, in particular with the younger generations more active into the stock markets compared to their parents and grandparents. What's happening is that the performance of the stock market is becoming the yardstick of a political consensus that is completely wrong. This has been used by Trump, has been used by the Biden administration, has been used by Trump again. Okay. And, if people want to do the right thing, so Trump did the right things for 4 days in total, basically. When they say the market needs to swallow the bitter pill for the good sake of the economy, then everything was about to fall apart. And then they had to have a U-turn massively on everything. Okay. And now everything is back to all-time high. And now we are again at the Trump market. When the market was going down, it was the Biden market that was going down. So there is all this fictitious sense of wealth being created on paper that is creating a massive distortion and a massive gap between the financial economy and the real economy. And, in finance, everything in the long term reverts to the mean, no matter what. So, and you cannot have this type of distortion for so long. Personally speaking, I thought they wouldn't have lasted for so long. I thought that, Trump with the second term, with such a popular support, he would have done the right thing, right? But at the end of the day, he ended up not doing so
Yeah, I remember.
because,
Sorry to interrupt you. I even remember Besant saying, we have to swallow this, like you said, and then when it got a little bit difficult and Wall Street started complaining, they did the U-turn.
yeah, exactly. So, because everything, it's a complete house of cards into the Western system. It's leverage on leverage on leverage. Everything starts with debt, continues with debt, is repackaged debt, so on and so forth. Okay, from a government level to a corporate level, down to every single person levels. And the more people cannot make their ends meet because their purchasing power is evaporating due to monetary inflation, the more you have consumer debt like raising massively, the more you have this buy now, pay later scheme that now people are using them to buy food. I mean, if that is not a huge warning sign for these people, then what do you wait for, right? And to your question is like, how long can they go? So, in my opinion, they can go as long as there is gonna be a significant popular uprising in the sense that Trump was elected effectively by overwhelming popular vote because people expected him to do the right thing, to go against the establishment, so on and so forth, right? And it lasted like for a few days. We had a similar case in Japan where the current government that represented the establishment for so many years now doesn't have a majority in both chambers of the parliament. Okay, so people are starting to get really frustrated and tired and stretched. So they have this type of protest votes. But and then there is the ultimate problem when the protest vote is not enough anymore, and people really struggle to put food on a table. Then we can go back in time in those historical cases where you have social problems, and as a matter of fact, these kind of social problems are starting to trickle in the society. For example, like, you know, I was living in the UK a long time ago, more than 10 years ago, and I come back like roughly once a year. And in the UK, personally speaking, I can see this deterioration of the structure of the society. You have on one side you have the Ferraris, the Lamborghini of the billionaire, of the middle, of the riches and whatever. You have all these high-rise apartments that, by the way, are totally unsold and whatever, but they make like the landscape very pretty. But at the same time, you have British people that cannot afford to live in Zone 3 anymore now. They can buy in Zone 4 and Zone 5 in London, if not even beyond. There are banks that are moving all their operation in Birmingham, Manchester, and whatever, but because it's becoming totally unaffordable, the city, despite you have less and less people living there because of Brexit, right? And then you have, crime rates on the rise, bankruptcy on the rise, all sort of things, right? Now the UK government is trying to increase taxation on the wealthier part of the population, but what happened is like these people simply hit the Laffer curve head first, and they realize if you increase taxation too much, people simply start to leave and you collect less and less taxes. So they have a massive fiscal law. So they cannot stretch this completely distorted structure forever. Okay. And at some point, the whole system enters in a self preservation mode, as you call it. And if they want to survive as they are without being replaced by a new system, like it happened like in history multiple times, they have to, you know, accept their reality and try to, you know, contain the fallout of the damages as much as possible because the damages are already there and they're hiding in plain sight.
Yeah, and what do you think could be the trigger, and I'm not talking just about the UK, but for the whole of the West and the US especially, do you think the because you talk you post a lot about that, and so do I. I've been following the Japanese yen carry trade for quite a while on my channel, and it's been happening for a couple of decades, but now it seems to be unraveling because Japanese interest rates are rising so quickly, especially in the longer end. Do you believe that that could be the trigger for the whole um, edifice of debt and financialization, not just in Japan but in the West?
So, personally speaking, I think that the we cannot spot the trigger right now in a sense that we have everyone has in mind this bubble and then a single pin popping it. Okay. But in reality, what's happening here is that we live in a global financial system nowadays that is so incredibly complex, interconnected, and structured, okay, that similar to a butterfly effect, something happening, maybe completely unrelated in one part of the globe, can create total chaos in another side of the globe. Okay. So, as a matter of fact, I believe that the trigger, okay, there have been already many triggers, but we see that there has been a coordinated effort to put the fire down. It happened in August last year when I correctly predicted all that unfolded, okay, with Japan interest rates because people in the US and Europe, they don't understand it. They see Japan as a massively far away country and whatnot. It's like what Japanese has to do with us, okay? But in reality, it's like all this debt that has been borrowed to carry trade through the year helped to inflate the assets in the US and Europe and whatnot. And now this debt is becoming more and more expensive. And then I heard some people say, oh, but this debt is not due to repayment right now. Okay. Well, they miss a small part of the picture, but I would say it's incredibly important that are derivatives. Okay. Because we see things as the 10-year US Treasury yield, the 10-year GGP yield, the FX, and whatever. Okay. That is the tiny tip of the iceberg. The whole structure of derivatives, cross-currency swaps, hedging, cross-border agreements like market agreement, OTC agreement, and whatnot, okay, effectively creates a system that it's function very well till there is trust. Okay, so if you want me to say what is gonna pop this bubble, I would say is perhaps like an implosion of trust that things can be bailed out by central banks. We saw in the UK, crisis of the pension funds. It was a massive problem. Things were about to go bananas. If things go bananas in the UK financial system, the ripple effects are going to be huge in the US, in Japan, whatever. Boom, this has been taken care of. Print a bunch of money, wire up the legislation, calm everyone down, move away. Everything that matters is trust because trust brings the credit lines open and the money market opens. We have the problem with the US regional banks. Why did they fail? Because they started to have these losses piling and piling up in their longer term treasury investment while they funded a massive amount of this with deposit and then they run out of liquidity. But when that ended up in crisis, you saw Deutsche Bank CDS swap spiking massively during in Europe in European hours. Like, why? What happened? Right? So then you see, all these type of intricacies like margin trading on stock and whatever. So trust is the silver lining across all these markets. So people that can be made whole of the financial commitment against their counterparts. So their counterpart will be there, or if they will not be there, someone can pick up the bill for them. How do you measure trust? That's incredibly difficult. Like, clearly, fixed income traders are trusting governments less and less in managing their government deficit. That's why yield go up. People, like, it makes me laugh every time so much. Like, how wrong is Wall Street? Like, the Federal Reserve is going to cut rate 5 to 6 times at the beginning of last year. So they did it even the previous year. And then I was saying, be careful because they might cut once or twice just because they want to give like some sugar high to markets in order to push Biden campaign a little bit. But yields will rise in the longer term. And that's what it happened. Okay. Because, all the like this incredibly low yield environment also becomes an environment in which people start lacking more and more financial discipline. Everything thinks free. Like if there is a problem, money can be printed out of thin air and whatever, right? And I mean, if people are happy to end up like Venezuela, where the stocks are through the roof, but the currency is through the floor, you know, I don't think the Venezuelan people are that happy about that. Okay. But nowadays people realize this ex post. So if at some point the trust breaks, then I think that's can be the pin. But how to measure it? To be fair, we can see the sign overall in the market, the sign of stress, but pointing it out at exactly what will pop the bubble, I think is too simplistic in this current financial environment.
Yeah, I agree with you. And the derivatives as well. There's especially OTC derivatives where they're so opaque, and some people argue that their notional amount are over 1,000 trillion or a quadrillion. And no, I agree with you. When the markets don't trust the central banks anymore, they don't trust that the central banks and the governments can fix things. That will be when things will really get interesting. And I think you always need to have some kind of insurance for that. And I can only see it outside the system with physical gold and silver, or even maybe crypto. I mean, I don't cover crypto anymore. I used to. Maybe you can talk about that. What do you think are the best ways to protect one's savings? And I'm not saying get out of the system altogether, but have some insurance.
Yeah, I totally agree with you. Gold, silver, potential commodities, other type of industrial commodities. And I can touch upon crypto later because a little bit of a different topic. But in terms of physical assets, art assets, what I tell everyone is we live in a time of incredible monetary inflation. Okay. So you have to picture um, ratio where you have at the numerator the growing amount of currency and that the denominator, okay, a specific quantity. Okay. So when you have gold, you have a fixed amount of gold that is out there and a very limited amount of gold that has been mined every year. That's your denominator. At the numerator, you have the money, right? So the more money they print, the higher the price, because that's exactly what a price is. Similar for silver, similar for other commodities. Another important thing that I tell people is like all this money that they're printing out of thin air, it will not be burned. Okay, it will not be removed from the system. Monetary inflation and the effect of monetary inflation are sloshing around in the system. They went quite hard in the real economy for quite some times. Now that we are seeing more the effects in the stock markets again. But at some point, people will love to take some profits and enjoy them. So when you have all these people to start taking profits, they will be spending them, right? The moment they spend, here you go again, back with the inflation, and so on, right? So I think people to protect themselves, they need to understand where this big bunch of money is going. And right now is clearly going a lot into these hard assets. Okay. Assets with limited supply, with a supply that, ideally speaking, can be stored outside from the system in vaults. Okay. And that is recognized broadly. A piece of gold is a piece of gold anywhere in the world. A piece of silver is a piece of silver anywhere in the world. If you go with $1 in Iceland, well, good luck. I mean, they might take it, if they don't think it's fake or whatever, but they want to have like a huge discount, right? If you take one Japanese yen outside Japan, or actually not one, maybe 10,000 because the currency devaluated so much, and you go to Europe, people are like, what is this? It's like anime action figures. It's like, can you really pay for something with gold? Can go around anywhere and you can actually exchange it for goods and services. Okay. So here is the shift that is going to happen. And people need to be very, very careful because, as I stressed, it needs to be physical. A lot of people are buying so many financial assets out there. Okay. And I want to give a simple question to them. How do you expect you buy an ETF and this ETF is so good to reflect the price, the spot price of gold and silver, claiming at the same time it has a physical storage? I mean, when you have a physical storage, you have a real estate infrastructure, you have guards, you have insurance, you have electricity costs and whatnot, right? That those type of costs they will go in your performance, okay, and effectively your performance will be always lower than spot systematically, plus management fee and whatever. So if you have an instrument that is so good at tracking the spot price, where are the costs, right? Because you must have those costs to store physical, right? So any instrument that follow this type of dynamic, and then let me start it about leveraged instrument, okay? They are effectively owning paper gold. They own a lot of paper that says that in a vault somewhere there should be gold belonging to them. But then why the vault operator is not charging them a arm and a leg to store all that amount of gold? It's very simple because they are allowed by the asset manager to lend that gold. And with the proceeds from lending that gold, the vault operator rebates the cost to them. Okay. And I mean, once this gold is out, it gets melted, it enters in circulation and whatever. Are they going to send it back? Well, good luck with that, right? So this is why physical is incredibly important, okay, to understand this concept. And we've seen already so many cases of people that got cash settlement or whatsoever. With regards to crypto, as I said many times, I'm not shy to say that at all. I mean, I'm a person that I work on crypto project. I've followed crypto project. I invest in the value crypto project, and I also say that 99% of that space is crap. In the same way that during the internet.com bubble, you had 99 companies that were completely fugazi, and one company that really had a long-term business plan that could effectively take off. The same is happening here. It's human nature. Okay? It is what it is. So within the crypto space, you have some speculative assets, okay, potential opportunity assets, because at the end of the day, behind this token, there are people and people that work for a living, people that want to see their net worth increasing, people that want to see revenues and whatever. You have a lot of scammer, of course, but same concept. They want to see their wealth increasing and whatnot, okay? And then you have a very, very, very tiny category of assets that, like Bitcoin, that I know that every time I say this, people are like, oh, yeah, you cannot say that. But if you put Bitcoin characteristic on one side and gold characteristic on the other side, the only thing that differs them is the physicality. Okay. Both of them can be cut into microscopic pieces. Okay. Bitcoin is not only trading one Bitcoin, you can trade even 0.000, whatever. There is a finite supply, there are specific dynamic, it cannot be changed, so on and so forth. Okay. So, and we live in a era where everything is digital. Okay. So gold was recognized as a store of value into the Western world simply because it had all the characteristic 2,000, 3,000 years ago that people can relay, okay, to exchange it for goods and services one side to another because you cannot transport wealth. You cannot like transport, whatever from one side to another is completely ineffective, okay? But when the Spanish went to South America, gold was has no value for them. They had other forms of currency representation. Okay, this is the perfect example. So Bitcoin has all the characteristic for a very big amount of people to assign a transfer value to it. Everyone agrees that that specific piece of code under certain condition represent this amount of value in fiat currency or equivalents in good and services. Here you go. You have a store of value, same as gold and same as others. Some people might like it, some people might not like it, some people might understand it, some people might not understand it, but at the end of the day, the world evolves, right? So, and in particular, in the new generations are more and more pushed towards everything that is digital because of their appeal. They're not even used to have like physical wallets anymore in their pockets. Everything is on the phone, right? So they might understand Bitcoin better than gold. Okay. Are there other assets in crypto like Bitcoin? To be fair, there are no other assets. Ethereum and other blockchain, they have their own characteristics and whatever, but they're more like an infrastructure play. You see more like a net of infrastructure where application and utility can be built upon, and then this net benefit from it, but it's not a store of value. Similar to gold. Gold doesn't pay dividend. Bitcoin doesn't pay dividend. Ethereum, you can stake it and pays interest. Everything that pays interest is not cannot be really considered as a great store of value. It can be increasing in values under certain market condition, but doesn't have all those items that you can bring it from one ecosystem to another economic ecosystem and whatnot. And every person will agree around the value of that specific item, either in physical or digital form.
Dario, that was great. I think we need to talk again, hopefully soon, because I want to ask you, and it will take, I think, a lot longer. Uh, how do you see maybe gold and the blockchain or Bitcoin combining? Maybe there is something there. I mean, a lot of people have been asking me about tokenization. So we'll leave that to the next talk if that's okay with you. And just wanted to thank you for your time. And it was great to talk to you.
Thanks a lot for the opportunity to be on your channel.
You're
Speak
welcome. And
soon.
for people who want to follow Dario, the website is justdario.com, and he's also on X. Highly recommend. He posts really interesting posts there. And yeah, have a great rest of the week.
Thanks a lot.